Yes, so we are very concentrated on the next move by the US Federal Reserve. They're expected to slash interest rates for the first time in more than 4 years. Global investors are wondering whether the Fed is going to opt for a rare and bold 50 basis point cut, or will the Fed stick to a 25 basis point cut in its pursuit of a soft landing to the US economy. India, of course, keenly watching out for the sectors and portfolio rejigs that could follow. Let's get perspective on where the markets could head. Manish Singh, market expert, joining us. Great to have you again, Manish. You know, while most
Hi, Victor.
analysts were holding the view that the American economy is fine, there is no recession right now, or even on the horizon, a soft landing with a 25 basis point cut was turning up to be the consensus view. But now I think things have slightly changed in the run-up to the FOMC meet. Haven't they, Manish? A 50 basis point rate cut doesn't seem completely unlikely.
No, it's not unlikely, and I think we are going to get that, and it is justified, because if you look at where the 2-year rate is, the 2-year Treasury yield is at 3.57, and the upper bound of the Fed fund rate is 5.5. So we're talking about 190 basis point spread. You have to go back to 2008 to see the spread this wide. Of course, at that time, you know that there was a crisis going on, and we got 75 basis point cuts. Now, of course, we're not going to get 75 basis point cuts now, because there's no crisis going on. But the reason why I think Fed is going to cut 50 and why it should cut 50 is that if the inflation is on track to be at 2%, it is at 2.5% now, what justifies the rates being this restrictive? We have seen the most rapid increase in rates in the last 40 years. The rates have been at 5.25% for 14 months. What justifies it being at this high restrictive level? There's no point.
Yes.
So I think for that reason, you're going to get 50 basis point cut.
But Manish, what do the markets really want? At the launch of the first rate cut cycle in 4 years, the first since 2020, since the pandemic hit us, what's the best case scenario for the equity markets right now?
Well, I'd say depends on who you ask. So for me, I would say that I think 50 basis point is the right thing to do. The swing and roundabouts you're seeing in the market prediction of rate cut 25 or 50 is just down to short-term tradings in futures that you see in rates market. That should not be a determining factor in where the rate should be. What I think the market is going to look for is that 50 basis point cut comes with a narrative which says that this is the right thing to do, the rates are very restrictive, but it doesn't come with the view that we are trying to avert a recession, which is not my base case scenario. Because if you look at where the leverage in the housing market is at all-time low, 27%. You look at of course, we know the stock market is all-time high, so that gives you a wealth effect. Housing prices have increased a lot over the last 3 or 4 years. That is giving you a wealth effect. You are still earning 5% on deposit, so that is giving you the income effect. You have 10% of US deficit being run on a federal level. That is going to come into spending, and that is going to come into the economy.
Yes.
So I do not see a recession coming over the next 6 months.
But it's going to be crucial, isn't it, Manish? What comes through in the commentary? What are the reasons you'd see them ascribe to a rate cut this time? Do you think they'll say it's because inflation is climbing down? Or will they allude to any kind of recessionary trends? Because any mention of the need to fight a recession could spook the markets.
Yeah, and I don't think there is need to even mention that, because if you look at where the jobs report is, right, we saw the job openings per number of unemployed, that has gone down from 2 to 1. That's been cut into half. Total job openings is at 7.6 million, which is the pre-COVID level. In fact, if you look at the FOMC members, their own projection of where the unemployment rate should be at the end of this year, the unemployment rate is higher than that. So there is a very genuine and good reason that why they should be cutting rates by 50 basis point, and the market should not panic, because those conditions have been met, and therefore the rate should come down.
But Manish, besides keeping prices in check, the Fed wants to ensure that employment levels are high, and it seems like the Fed is trying to work more on jobs than inflation. Would that be a correct reading at this time?
Yes, I think the focus has shifted to jobs and economy.
Yes.
And it should shift to jobs. And if it was not for US election, which is the elephant in the room, and I don't think they're going to talk about it, then I think that rate cuts would have started last July. The only thing that Fed is wary about is that depending on the outcome of that election, let's say for instance, we think that President Trump comes back and he puts tariff and the inflation goes up from 2.5 to even 3 or 3.5%, then Fed cannot cut rates. But that will be just the wrong thing to do. And that is the complication which they will have to bear in mind as they tide through this FOMC meeting and the next one closer to the election.
So between September and the end of this calendar year, by which time, of course, the American election should be done, how many rate cuts are you seeing come through? What do you reckon is going to be the quantum of each cut as well?
Well, I think if we look at the projections, and we can go by SEB that we've had so far, and various commentaries from central banks, from the FOMC members, I think 100 basis point by the end of this year, cut by 100 end of this year, looks on the table. Whether it goes 50, 25, 25, or 25, 50, 25 is a different matter. But it does come down to that. That is what Fed is targeting. That's what the FOMC members are targeting. But if you look at the overall cycle where the rates could go to, look at two-year rate. Two-year rate has always been a good predictor of where the Fed fund rate should be eventually, and that is at 3.5. So we're talking about at least 175 to 200 basis point cut this cycle. Now that could happen over the next 9 or 12 months, not necessarily over the next 6 months.
Interest rates go down in an economy, Manish, things become cheaper to borrow. So households are more inclined to buy more goods and services, and then businesses have that rise in demand that they seek to borrow more funds, expand operations, perhaps build higher capacities with more equipment, etc. They would invest in newer projects, and then they create more jobs, and then wages rise as well. Is that what you see happening this time with the American economy, or is this different?
Yeah, no, I think that's what is likely going to play out. I find very hard to make a case for recession in the present circumstances that I have mentioned. Is that the federal deficit continues to be at 8 to 10%. You saw the deficit number we got for last month. It was at a record high. So if you have money being spent, clearly you're not going to see a recession. The only point is going to lead to inflation because money supply is expanding. And those things have been taken care of in the sense that the supplies have improved. The job market is not as tight as it was in the past. So those things are being taken care of. So it's a very difficult case to make that recession is going to happen. What you're really going to see a continued growth, which means the equities are going to go higher.
Yes, but Manish, the moving piece, one of them, of course, is the outcome of the American presidential elections.
Yeah.
But this is a time that we are also seeing the Chinese dragon not spewing fire. In fact, quite the contrary. China is dealing with a real estate crisis. Their manufacturing is slowing down. So a revival in economic activity in the US, that is required to help raise global growth that has been going down. So equity markets are going to be looking at the American economy that much more closely and get affected by how the Fed takes its decision.
Well, that is certainly the case because I think the world market looks at what Fed does and what happens to dollar, what happens to oil to take their cue. But Vikram, remember, a lot of thing is about sentiments. You can easily turn a bullish argument to bearish argument by just choosing a different set of statistics. So I would say that not to focus too much on short-term market moves. You saw the yen carry trade unwind that happened in August, and then people bought back equities. You know, Japanese yen actually is much stronger today than it was in August. From there it went from 160 to 144. Today is 140. So yen is stronger and equity has gone higher. How do you explain that? So it's not just about one or two data points, how that impacts. So I like to look at what's happening over 6 to 12 months. And on that basis, I just do not see concern about where recession or economic stagnation is going to come from. To the contrary, if there is a deal between US and China, which may happen after the election, then you might have renewed growth.
But since you're talking about currencies, typically the US dollar would weaken with a rate cut cycle and help other global currencies to rise. Is that the case this time, or do you see a capping of the downside on the dollar? Is this scenario different?
I think I'm not an FX guy, so I think it's very difficult to put targets where things are going to be. But I would imagine that interest rate parity differentials are going to play out, and you will have dollar a bit weaker.
And gold, typically of course, as commodities go, I wanted to ask you this as well. It has a negative relationship with bond yields because most of the demand is for investment purposes. And right now we're seeing gold at record highs. Do you think gold prices are going to rally higher with Fed rate cuts?
From what I read, that gold is being bought by central banks, China included, and the Middle East as well. So if the buying is happening for stocking levels, then it just doesn't matter where the rates are, if central bank comes into buying gold. So it's difficult for one to say where it's going to be. But as I've always maintained, that gold is your ultimate insurance. It does have a place in the portfolio, but not for return reasons, but for insurance reasons.
Sure, it's always a pleasure getting in your perspective. Thank you very much for joining
Thank you
us
for having me.
on this edition of India Tonight. We'll watch out for the Fed and what it decides by way of interest rates, the quantum, of course, and sometimes the Fed can surprise in a big way. They've done that in the past. There's no reason to believe that they won't this time around as well.
If you like this video, then like, share and subscribe to ET Now.